What happens when two of the fiercest rivals in the semiconductor world suddenly join forces? You get a game-changing alliance that could reshape the future of artificial intelligence, gaming, and global chip manufacturing. NVIDIA has just announced a $5 billion investment in Intel. These two longtime competitors are teaming up to co-develop the most powerful CPU-GPU hybrid chip ever built, a chip that can dominate both AI data centers and high-performance gaming PCs. But this story goes far beyond silicon. It has massive implications for investors, from beginners to pros, because this deal could reshape market leadership in the semiconductor space for years to come. Let's break down what this means for NVIDIA, for Intel, for their competitors, and for your portfolio. NVIDIA's $5 billion equity stake in Intel comes with a clear vision. First, the two companies will co-engineer chips for data centers by combining Intel's x86 CPUs with NVIDIA's new Blackwell GPUs. These systems are designed to handle the heaviest AI training workloads. Second, they plan to bring this same integration into consumer hardware. The goal is to create gaming PCs that pair Intel's processing power with NVIDIA's RTX graphics, a combination aimed at pushing gaming performance and efficiency to the next level. For NVIDIA, it is about tightening its grip on the AI infrastructure stack. For Intel, it represents a lifeline back into the spotlight. And for competitors like AMD and TSMC, it raises the stakes dramatically. NVIDIA's decision to partner with Intel is strategic in four major ways. First, it helps solve a technical challenge. NVIDIA's NVLink interconnect can now integrate more seamlessly with Intel's CPU architecture, reducing latency between GPU and CPU. Intel's Foveros 3D chip packaging adds another layer of efficiency, filling a gap in NVIDIA's supply chain where it has long relied on TSMC. Second, this is a bid for market expansion. NVIDIA and Intel are setting their sights on AI PCs, a space AMD's Ryzen AI and Apple's M series currently lead. In data centers, NVIDIA plans to pair its Blackwell GPUs with Intel CPUs to take on AMD's MI300 series and ARM-based solutions from Ampere and others. Third, the partnership aligns with U.S. government policy. Washington has pushed for reshoring chip production. By teaming with Intel, a domestic foundry partner, NVIDIA reduces its dependency on TSMC and gains political leverage, especially regarding export licenses for its H20 chips to China. Fourth, it's about ecosystem control. NVIDIA is gradually opening parts of its CUDA software to build a broader x86-based development platform. This could strengthen its position against competitors like AMD's ROCm and Huawei's Ascend. This deal is more than just helpful for Intel, it's critical. Intel's client computing group still brings in over 60% of its revenue, but sales have declined over multiple quarters. Global PC shipments are stabilizing, yet Intel continues to lose share to AMD and Apple. Its data center and AI business has posted modest single-digit growth, but profitability remains weak. Its foundry services division is one of the few bright spots. In Q2 2025, it generated $4.4 billion in revenue, up about 3% year-over-year, driven mainly by internal orders. With NVIDIA now in the pipeline, external demand could scale significantly over the next 12 to 24 months. Intel's 18 amperes process node has entered production, but still lags behind TSMC's N2 node in terms of yield and efficiency. The upcoming 14 amperes node offers promise, but remains in development. Financially, Intel is under pressure. In Q2 2025, it reported a GAAP net loss of $2.9 billion, up 82% from the previous year. Management has announced layoffs of up to 25,000 employees to reduce costs, but these measures come with severance and restructuring expenses that will weigh on future earnings. NVIDIA continues to thrive. In Q2 2025, it reported $46.7 billion in revenue, up 56% from the same period last year. Net profit reached $26.4 billion. Gross margins held strong at 72.4%, and operating margins exceeded 60%. Looking ahead, NVIDIA expects revenue to exceed $54 billion in the next quarter, excluding H20 chip sales. Analysts estimate a forward price-to-earnings ratio around 30 based on 2027 earnings. That is elevated compared to the S&P 500's average of 21, but lower than NVIDIA's 5-year average of 45. In comparison, AMD trades at a forward P divided by E of approximately 32 to 35, while TSMC trades between 20 and 25. NVIDIA's strong cash flow and high R&D investment remain key reasons analysts support its premium valuation. The clear winners so far are NVIDIA and Intel. Following the announcement, NVIDIA's stock rose 3.5%, while Intel surged nearly 23%. The combined market cap gain exceeded $140 billion overnight. Intel gains a long-term growth lever in its foundry business and access to the CUDA ecosystem. NVIDIA gains supply chain flexibility and deeper integration in AI server architecture. But others may lose ground. AMD now faces a stronger combined rival in both PC and server markets. Apple may be insulated by its closed ecosystem, but could see pressure if x86-based AI PCs begin to scale. TSMC might lose some high-value packaging contracts if Intel becomes more competitive. This deal is about more than just chips. It signals a return to vertical integration and strategic tech alliances in the U.S. semiconductor sector. It recalls the 1980 seconds when American chipmakers formed alliances like the Semiconductor Research Corporation to fend off Japan. Now, with rising U.S.-China tensions, controlling both design and domestic production is becoming a national priority. This partnership checks both boxes and may mark a major turning point in the industry. What do you think? Is this deal the comeback Intel needed? Does it strengthen NVIDIA's dominance in AI and data centers? Let us know in the comments. If this breakdown helped you, give the video a like, share it with someone tracking the chip industry, and subscribe to TradingKey. Thanks for watching. See you in the next one.